Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Business investment decisions are some of the most important choices leaders face, whether it's buying a company, launching a product, expanding capacity, or investing in new technology. When done right, these decisions help build lasting competitive advantages, drive growth, and increase shareholder value. On the other hand, poor decisions can waste capital, divert management's focus, and weaken an organization's strategic position. Even with so much data and expertise available today, many companies still fall into common traps due to biases, wrong assumptions, weak governance, or lack of disciplined execution. These issues happen across all industries and economic conditions. In this presentation, we'll look at the most frequent pitfalls in business investments, their real-world effects, and ways to avoid them. By sharing examples and practical advice, the goal is to help leaders make smarter, more resilient investment choices that add real value over time. Avoiding common investment pitfalls brings clear benefits across several key areas. When businesses invest with discipline, they see better returns on their capital, which helps improve cash flow and strengthens the overall financial health of the company. This disciplined approach also ensures that investments align closely with the company's strategic goals, focusing resources on initiatives that build competitive advantage instead of chasing trendy but potentially risky opportunities. Additionally, a structured investment process helps reduce downside risks by identifying and managing potential problems upfront, preventing major losses. It also supports faster learning within the organization through clear decision-making frameworks and regular reviews, which improves future investments and execution. Finally, making consistent, well-reasoned investment decisions builds trust and credibility with shareholders, boards, lenders, and employees, which is a valuable asset for any business. Overall, avoiding these pitfalls isn't about playing it safe. It's about making thoughtful, evidence-based choices that support long-term success. One common mistake in business investments is overconfidence, where leaders tend to overestimate revenue and underestimate costs, expecting everything to go more smoothly than it actually does. This often leads to business plans based on what they want to happen rather than what's likely to happen, especially in uncertain areas like acquisitions or new market expansions where emotions can cloud judgment. Another pitfall is relying too heavily on past success, assuming that strategies that worked before will keep working even when market conditions change. For example, a company might keep making acquisitions despite higher costs or stretched integration resources, causing capital to be invested based on outdated patterns rather than current realities. Finally, risk assessments are often shallow or incomplete, with important risks either overlooked or insufficiently measured because they are uncomfortable or inconvenient to address. These hidden risks can include things like how complicated integration will be, misalignment in company culture, changes in regulations or politics, technology becoming outdated, or overdependence on key talent. Recognizing and addressing these pitfalls is crucial for making smarter investment decisions. Focusing too much on short-term financial results like immediate earnings or near-term return on investment can overshadow the need for long-term strategic investments. While managing finances carefully is important, a narrow focus can lead to underinvestment in the capabilities and options that build future value, ultimately weakening long-term competitiveness even if short-term numbers look good. Additionally, poor governance can undermine investment decisions. When leadership dominates discussions and dissenting opinions are silenced, or approval becomes a mere formality, weak investments proceed without proper scrutiny. This makes early mistakes hard to correct later due to political or financial constraints. Finally, strong strategy alone doesn't ensure success. Many projects stumble during execution due to unclear accountability, lack of resources, ineffective change management, and inadequate performance tracking. These gaps often cause investments to fail after they're approved rather than because of poor initial decisions. Even when an investment idea starts strong, value can slip away if we're not careful. To prevent this, the first step is to clarify the strategic intent behind the investments. Decision makers need to ask how the investment supports our competitive edge, what specific problem it solves, and what success will look like in 3 to 5 years. If an investment can't be clearly linked to our strategy, it should face more scrutiny. Next, it's important to separate those who propose the investment from those who evaluate it. This independent review helps improve decision quality and reduces biases. Methods like red team versus blue team reviews, independent scenario modeling, and external benchmarking are effective ways to encourage critical evaluation. Finally, forecasting should move away from relying on single point estimates, which can give a false sense of certainty. Instead, we should look at a range of outcomes, including best case, base case, and downside scenarios, conduct sensitivity analysis on key assumptions, and use probability-weighted outcomes to better understand the risks and opportunities involved. This approach helps ensure investments are evaluated more realistically and thoroughly. Shifting the conversation away from just asking if something is good, we focus instead on understanding under what conditions it might fail. This means explicitly pricing risk by adjusting expectations, using higher hurdle rates, implementing staged investment commitments, or adopting option-based structures like pilots and scalable phases. We recognize that not all investments carry the same level of uncertainty, so those with higher risk should offer either stronger potential returns or greater flexibility. Next, it's important to link the decision to execution by ensuring every investment has clear ownership, defined milestones, and both leading and lagging indicators, along with pre-agreed review points. If execution struggles, the organization must be ready to adapt or exit decisively. Finally, conducting post-investment reviews is essential for learning. Comparing outcomes against original assumptions helps identify what expectations were met or missed, which assumptions were wrong, and what should be adjusted in future investments. The goal is to learn and improve, not to assign blame. One example shows how a global consumer goods company overestimated its ability to expand a niche brand internationally, leading to a failed acquisition. They overlooked important cultural differences, supply chain challenges, and risks to the brand's identity. While sales were strong at first, profit margins fell sharply and growth stalled, resulting in a significant financial write-down. This highlights the danger of optimism bias and not assessing risks thoroughly. Another case involves a manufacturing firm that invested heavily in a new ERP system, expecting efficiency gains. However, they didn't plan well for execution, training was inadequate, change management was weak, and responsibilities were unclear, causing disruption and cost overruns. Lastly, a professional services firm avoided common pitfalls by taking a cautious, staged approach when entering a new geography. They launched a pilot office with clear success criteria and exited quickly when those weren't met. This disciplined approach limited losses and protected capital. Overall, following a disciplined investment strategy helps deliver more consistent returns, reduces the risk of losing capital, strengthens strategy alignment, encourages organizational learning, and builds resilience in uncertain markets. A disciplined approach to managing risk doesn't remove risk altogether, but it helps ensure that risks are understood, properly priced, and actively managed throughout the decision-making process. However, this approach has some limitations. It can be time-consuming because structured evaluations take effort and may slow down decisions. There's also a risk of overanalyzing situations, which can cause hesitation and missed opportunities. Using frameworks doesn't guarantee success either. Poor assumptions can still lead to mistakes, and relying too much on these tools might give a false sense of security. Additionally, strong challenge and review processes can be uncomfortable for some leadership teams, leading to cultural resistance. These points highlight the importance of finding a balance, being rigorous without becoming paralyzed by doubt. Ultimately, improving investment outcomes is not about predicting the future perfectly, but about enhancing judgment in uncertain situations. Most failures happen not because the idea was bad, but because biases went unchecked, risks were ignored, or execution was poorly planned. By clarifying strategic intent, separating advocacy from objective evaluation, explicitly pricing risk, and committing to disciplined execution, businesses can significantly improve how they allocate capital. This capability becomes a real competitive advantage, especially in environments where capital is limited and uncertainty is high, making it one of the most valuable assets a company can develop. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.